G'day everyone, welcome back. Today you're talking about the objective rules. So this follows on from the previous section, which was more about the way that we quantitatively and statistically analyse our signals. We're getting a little more here into the actual how we define our signals and how we quantify, if you like, our technical analysis. Now, you know, my opinion, I've travelled a lot, I've talked to a lot of technical analysts, I've talked to a lot of quantitative analysts. Most quants that I know really are technicians, and so, you know, don't think about them as that you've got fundamental analysts and you've got technical analysts and you've got quantitative analysts. I actually believe the quantitative analysis is a sub-branch of technical analysis. It is taking the same types of interpretations on data like we do. Maybe the math is at a higher level and there's a lot more calculus and things going on, but it is still at the core the same concepts as technical analysis. So I actually believe that as technical analysts we need to really own this space of being very quantitative about our work. And that's why these sections are so important. But okay, objective rules and their evaluation. So obviously we're talking about the terms of being objective versus subjective. You know, and there's so many disciplines in technical analysis that, you know, that they aren't objective. They're very subjective. Even trend line analysis, really, at the end of the day, is quite objective. I once saw a presentation on trend lines, and you know, the market was going up and the line was drawn. And you know, when I looked at the chart, I'm like, hang on, if we got rid of that last year of data, then you wouldn't have drawn your trend line like this. You would have drawn your trend line there. So, you know, it kept getting adapted as data comes in. And look, that's fine, and there's nothing wrong with that. If there are people out there that are really good at subjective analysis, you know, even be it some of the GAN analysis and things like that, that's fine. Elliott wave, you know, we've talked about already. I actually deem Elliott to be quite a subjective branch of analysis because it's very, very hard to accurately computerize that. Now, some people have done a great job. There's a company, L-Wave, I think, that does a really good job of it out in the Netherlands, but it is hard. There's no simple rules around that. So it is a subjective type analysis. Now, that's all well and good, and if you're dealing with a couple of charts and a couple of securities, fine. But if you're trying to find opportunities across the whole market, well, then you've got to be a lot more objective about the types of things you're looking for. If you want to create a strategy that takes your emotion out of the decision to trade, well, there again, you need to be objective. You need to have done that testing to know how well your system works. But first of all, to get there, we need to have some very clearly defined and unambiguous rules. Other ones, you know, as I said, the technical analysis techniques are a lot more subjective. All right, so the objective test, when we have a technical analysis idea, how can we know that it's objective? Well, simply, can we program it? Can we define it as a script, as a set of rules that you feed into a computer that will completely and objectively execute those rules and give you an output? And that's what we're trying to get to. You know, at the end of the day, our rules are supposed to come out with two conditions. Are we going to buy or are we going to sell? Now, in this chapter, David Aronson really focuses on the binary rules and the binary output. I would sort of lean towards, well, there's buying and then there's exiting, and then there's selling and there's exiting. You know, so there is that third state of being out of the market. But for the situation here and what we're talking about here, everything's in this concept of a complete reversal system where we're buying in and then we reverse to come back out. The thing which is great about computers is that there's no emotion, there's no, you know, they're just going to make those decisions. Whatever we feed into them, garbage in can be garbage out, but whatever we feed in, that's what's going to drive the rules in our system. The downfall of computers is that, whatever happens and whatever the rules are, that's what it's going to execute. Even if that execution is completely ridiculous by anyone who's standing by and watching. So, there's always pros and cons to everything. So the binary rule is the simplest, has only two possible outcomes, +1, -1, long, short, that type of thing. Binary system is always in the market, it's either long or short. We call these reversal rules. Parabolic stop and reverse is a classic indicator that operates this way. You keep staying in the market until the reverse has been breached, and then it flips over and you're in short and continue on that way. Another way of doing this with binary rules is thresholds. So if we have something like the RSI on that chart there, 10-period RSI, we may say that our rules are when it crosses below that 30 value, that threshold of 30, then we are going to buy and enter the market. And that's those blue arrows that you can see on the chart there. And then our other rule may be, well, we're going to sell and reverse when we get above the 70% line there, or that threshold. And so we're going to be alternating between those values there. Whenever we have multiple arrows, obviously we're already sold, so we wouldn't sell again. And so that's a very simple system using binary rules and thresholds. Thresholds can be fixed, like this one, where it's a fixed value, or it can be something that varies over time, like a moving average. So price crossing above and beneath a moving average may be the threshold that I'm using for my binary rule, but it is one that varies and obviously changes. It's not a fixed number. The other thing obviously we can do is multiple thresholds. So in this case, I've got some Bollinger Bands around the price action of Sprint Corp. What I'm doing there, my rules simply are that I'm going to buy when the high of the bar pokes through the upper band, and then I'm going to sell when the low of the bar pokes through the lower band. And the shaded areas are when I would be in the market under that strategy. And so you can see how that works there. And again, we're taking these three levels and quite complex rules, well, relatively more complex, and we're creating a binary condition. I'm either in or I'm out. And so that's the whole idea of multiple thresholds, that we have these multiple levels, and we are looking for crosses and things like that. It could be slow moving averages. I could have done a moving average band around that, a fairly slow one. And again, using that with a band as a threshold. So when I break beneath the bottom one and I'm beneath both, then I would sell and I wouldn't rebuy until I break above, price breaks above both moving averages. So there's a number of different ways that you could do that. But it still comes back to being a binary decision at the end of the day. All right, traditional and inverse rules. So obviously we have our traditional rules. Now, so much of technical analysis, a lot of the concepts we talk about, these ideas were developed, let's say, decades ago, in the 80s and the 70s and the 60s and back down to the turn of the century. Back then, you didn't have the luxury that we have now. You don't have the ability to have a computer and just test all of these ideas from a quantitative basis. So these guys were creating these ideas, they were observing them, they were seeing that it works, and they were making basically assumptions that they continue to hold across all markets and across all market conditions and things like that. So a lot of the technical analysis that we've talked about has been the traditional interpretation of those rules, of those signals. And again, when you go into CMT2, we talk about this again, how, what type of signals that we can derive. Well, those traditional signals, when we do our testing on that and we find out what the results are using that, what we should always do is actually the inverse and say, well, let's do the opposite. And what do we get? So instead of buying when price crosses above the moving average, let's sell when price crosses above the moving average. And we want to see, do we get a spread in our results? If we do, then great. Then definitely this signal has added value and there's an advantage. But if my traditional signal goes like this and my inverse signal goes like this, well, then I've got to be sitting there and asking, well, you know, is there real validity to this signal and this traditional rule, or is it something that I should be looking at? So one of the things that we want to do here at Optuma is really go through all of these rules from a very quantitative basis and create a little bit of a registry, if you like, of technical analysis techniques and traditional signals, and be able to rank them very easily. So watch out for that one as well. Sign up to our blog if you want to keep up to that. That's at optuma.com/blog. You can sign up there, and you know, we'll let you know about that. All right, detrending the data. The last slide here. We are, you know, sometimes when you're dealing with signals like this, like I was just saying, you know, it's actually the trend of the market that has been driving the prices higher. Well, again, this is why we want to detrend the data sometimes to calculate the returns. Now, you would never use detrended data as part of the signal. You know, we want our signals to be on the raw data, but when we're looking at the returns, then having detrended data can help a lot. Again, an easy way of doing that is just to take an average, moving average like that, and just subtract the closing price from the average. Now that moving average there, it's a 34 period moving average. It was a nice fit to the data. I offset it by 17 bars, so it had a central average rather than being lagging by 34 bars. The plot down the bottom is part of our Hurst tool module. It's an inverse moving average, does exactly that, but presents it as an oscillator. If I calculate my returns using this, then what I've basically done is, again, I've taken trend out of the picture for the security, and I'm just looking at, does my signal give me value? Does my signal help me identify times in this security where I can create a profitable trade and accurately predict where the trend's going? Remember, that's our core focus as technical analysts, is predicting trend. And so, you know, that helps me do that. All right, so that's the objective rules and their evaluation. Obviously, you need to be able to distinguish what's an objective rule versus a subjective rule in technical analysis. You know, saying something like, I'm going to trade when the trend line gets steeper. Well, that's a subjective rule. If I say, you know, you can have these automatic trend lines which calculate off highs and lows, and to say I'm going to trade on the break of that, where the definition wasn't a manual process or a subjective process, then that would be an objective rule. Or crossovers of moving averages, they're objective rules. Binary rules being that either I'm in or I'm out, using individual thresholds, and then multiple thresholds as well. You need to know about that. Obviously the traditional and inverse rules, and then regular data versus detrended data. Make sure that you understand the difference. And I think, you know, one of the clear things that sort of jumped out to me was, don't use detrended data for your signal. You only use the detrended data when you calculate the returns from your signal. And so that's very important there. All right, so that's objective rules and their evaluation, and we'll continue on with the course in the next video.